Friday afternoon, 3 branches in LaGrange, Georgia. Doors locked. By Saturday morning, a bank in Florida already owned the deposits. Monday, the branches reopened under the new name. $27 million of customer money sitting above the FDIC line is now in question. The second bank to fail in 2026, and we are now only in May. Here's the part that nobody's reporting. The FDIC sold this bank the same day they closed it, the same day before the press release went out. Check this video out and watch how this all unfolded and learn about what's to come.
Friday afternoon, 3 branches in LaGrange, Georgia. Doors locked. By Saturday morning, a bank in Florida already owned the deposits. Monday, the branches reopened under the new name. $27 million of customer money sitting above the FDIC line is now in question. Second bank to fail in 2026, and we are only at May. Here is the part nobody is reporting. The FDIC sold this bank the same day they closed it, same day, before the press release went out. The bank in Chicago that failed in January, same thing, closed Friday, sold Friday. That is not an accident, that is policy. Today, I am going to walk you through what actually happened in LaGrange, the Federal Reserve order from last month nobody saw, why the FDIC is now selling failed banks before the public can react, and exactly how to position so you are never the one calling the 866 number on a Saturday morning. Here are the official numbers. Community Bank and Trust, West Georgia of LaGrange, $288 million in total assets. $268 million in deposits as of December 31st. $27 million sitting above the $250,000 FDIC insurance line. The FDIC's own deposit insurance fund is going to take a $97 million hit on this single failure. That is the cost the rest of the banking system absorbs through quarterly assessments, which then get passed back to every other bank's customers as fees. Acre Bank of Palm Beach Gardens, Florida, bought what the FDIC press release called substantially all insured deposits and certain assets. That word certain is doing the heavy lifting in that sentence. They took the good loans, the performing assets, the healthy customer relationships. The FDIC kept the rest. The bad loans, the underperforming paper, the inventory that nobody wanted at any price, those will be liquidated by the FDIC over time at whatever they can recover. The cost difference between what those assets sell for and what the bank owed depositors above the insured line, that is what becomes the depositor's problem. And here is what almost no major outlet reported. Banking Dive caught it. The Federal Reserve filed an enforcement action against this bank's holding company last month. April 2026, order, bolster board oversight, improve senior management, increase capital position. That document was public the day it was filed. It sat on the Federal Reserve's website. Anyone who searched for the bank's holding company by name could have seen it. Customers banked there throughout April, made deposits, wrote checks, set up direct deposits, held estate accounts during probate, parked proceeds from house sales. Nobody told them. The system is not designed to tell them. The Fed files the enforcement action publicly. The bank is required to comply. The customer is on their own to know it exists, by design. $27 million in uninsured deposits is not one wealthy guy with a margin account. $27 million is the small business owner with $400,000 in payroll cash. It is the contractor holding $300,000 in retainer deposits across active job sites. It is the family that sold their house in March and parked the $480,000 proceeds. It is the retiree who consolidated their accounts to make life simpler and never bothered to split them again. It is the estate account during probate. These are not speculators. These are the people who picked a community bank specifically because the staff knew their name. The teller remembered their kids' birthdays. The reward for that loyalty, they are now setting up appointments with the FDIC to discuss their deposits. That phrase is verbatim from the FDIC notice. It is not a guarantee to get all their money back. It is an appointment. The phrase the FDIC uses about the 27 million figure itself is likely to change once the FDIC obtains additional information. Translation, the 27 million number could go up. Now back to the question I opened with. Why did this bank fail Friday and sell the same day? Why did the Chicago bank also fail Friday and sell the same day?
Hey everyone, real quick, sorry to jump in. When banks start failing and the numbers start rising, it actually adds tension into the mortgage system, and people can't get mortgages or the rates go up. It causes a lot of confusion. I've put together a bundle of 2 courses, the Mortgage Master and the Investor Mortgage Pro course. It has changed the game for thousands of people. They save thousands of dollars literally at closing because they know so much more than the average person when they walk into a brokerage. Link is down below. I'll throw a sale down below. It is literally a game changer. I'd highly suggest checking it out. Now let's get back to this video.
The answer has a name: Travis Hill. He became FDIC chair in 2025. He rebuilt the failure resolution machinery deliberately and openly. He told the banking industry directly he wanted faster transactions. He cited Silicon Valley Bank as the failure mode he wanted to never repeat. The SVB resolution took the FDIC weeks. Bidders had time to walk away. The asset value eroded while the agency searched for a buyer. Hill said publicly that the longer the FDIC takes to sell a failed bank, the harder it becomes to find willing buyers, and the more the deposit insurance fund pays. His solution? Pre-positioned buyers, same-day sales. The FDIC now lines up the acquiring bank before the failure is even announced. The deal is structured before the doors lock. The acquirer signs the purchase and assumption agreement during the work week. The state regulator declares the bank insolvent Friday afternoon. The FDIC steps in as receiver. The press release goes out. The buyer's name is already in it. In 2025, the FDIC voted unanimously to rescind the post-2008 policy that had barred non-bank firms from acquiring failed banks. Hill's words, quote, "remove regulatory barriers to non-bank participation in the failed bank process with the ultimate objective of lowering the cost of failures to the deposit insurance fund." Translate that. The institution responsible for resolving bank failures just widened the pool of who can buy a failed bank, accelerated the timeline from days down to hours. When a regulatory agency rebuilds its failure infrastructure to operate at maximum speed, that is not optimism, that is preparation. The FDIC is not streamlining to be efficient. It is streamlining because it expects to use the machinery. The cost of that speed is not free. It is paid by the depositor sitting above the FDIC line. Same-day sale means the customer never gets a window to move their money, never gets a Saturday to call their accountant, never gets time to consult an attorney, never gets a chance to redistribute deposits across multiple institutions. The press release is the warning. By the time it is printed, the resolution is permanent. The buyer is already named. The deal is already signed. The customer's only remaining option is the 866 phone number. That is why the $27 million in LaGrange is in question right now. The customers did not have a Saturday to react. The doors locked Friday afternoon and the deal closed before they had finished dinner. 2024, full year, 2 bank failures. 2025, full year, 2 bank failures. Already matched. Both 2026 failures share a profile. Metropolitan Capital in January had 82% of its portfolio in commercial real estate and private equity. Community Bank and Trust West Georgia was a community lender with classic CRE exposure. The FDIC's own Q1 2025 risk review confirmed past due and non-accrual rates on commercial real estate loans at the highest level since 2014. 31% of all U.S. banks are CRE concentrated. That means CRE loans exceed 300% of their Tier 1 capital. When that loan book starts breaking, those banks have nowhere to absorb it. The FDIC problem bank list grew in the fourth quarter of 2025, from 57 banks to 60. These are banks with serious weaknesses. The depositors at those 60 banks have no idea which 60, by design. 60 banks, faster failure machinery built for it. The third closure is being underwritten somewhere right now, probably on a balance sheet the regulators have already flagged. The depositors will not know. 3 rules from this moment on. Rule 1, know your number. $250,000 per depositor, per bank, per ownership category. Anything above the line is uninsured in a resolution. Cyprus, 2013, depositors lost 47.5% of their uninsured deposits. The line is real. The line gets enforced. The line above 250,000 has no such guarantee. Rule 2, spread the deposits. Multiple banks, joint accounts, and trust accounts can stack coverage. A married couple can structure up to $1.5 million if they set it up correctly. They have to verify the structure. The FDIC publishes a tool called EDI, Electronic Deposit Insurance Estimator. Free, public, available at fdic.gov. Most depositors have never used it. Rule 3, watch the regulators, not the headlines. The Federal Reserve publishes enforcement actions in real time at federalreserve.gov, searchable by bank name. The customers in LaGrange could have seen it on April 1st. Now you do. Here is the deeper move. If your wealth is above the FDIC threshold, the harder question is whether the structure makes sense at all. A bank deposit is an IOU. Above the line, you are an unsecured creditor. The asset classes that do not carry that counterparty risk: physical gold, silver, Bitcoin in self-custody, productive real estate. None of them depend on whether the bank you chose was on a Fed enforcement list. The FDIC built the infrastructure for a reason. The choice is whether to act on it before the next Friday afternoon press release or after. I hope you enjoyed this video. Economic Ninja is out.